Let's go across the market open. David Lane joining us from Ord Minnett. David, welcome to Wednesday.
Thanks,
September, the
Andrew.
negativity we see here is seasonality at play. We've begun negatively. Certainly that's going to continue on the local market today off the back of those leads, certainly off Wall Street.
Yeah, it certainly looks like that, Andrew. We've, obviously had a very, very volatile August and a lot of news coming through. But yeah, taking those leads from the US and Europe, in fact, overnight, we saw the European markets down fairly significantly. Their bond market in the UK in particular saw the 30-year bond or gilt yield rally fairly significantly. So it's actually at the highest level it's been for 30 or so years, since 1998. So UK market concerned about the rising levels of debt there. Similarly in France, their GDP or their debt levels are about 120% of GDP. So the European market's concerned about debt, and sort of in the US as well. US market was sold off. Their bonds were also rallying reasonable amount as well. So yeah, negative lead in from international markets.
Also, some concern over that court ruling on Friday, David, out of the US, essentially ruling that Donald Trump's tariffs are illegal. They've got until mid-October to appeal, but that's clearly also unnerved markets.
It has, yes. Certainly more uncertainty there as far as the tariffs are concerned. Donald Trump, as you would expect, doesn't seem to be too concerned about that. He was asked about whether or not he's going to look at changing the tariffs for India in particular, and he said no. So yeah, it looks as if he'll attempt anyway to keep pushing those through. But yeah, we have seen some concerns in the US. There were the ISM manufacturing numbers that came out last night, indicating that their manufacturing sector is still struggling. It was the sixth month that we've seen negative, or effectively a contraction in manufacturing in the US as well. So yeah, I think the economy and markets are probably a little bit more concerned about the tariffs than Mr. Trump is.
Now, we've also seen the tech sector continue to be sold off. This coming in the wake, of course, of NVIDIA's results last week. And NVIDIA itself, in fact, the share price falling below that 30-day moving average.
Yeah, correct. Yeah, it was down nearly 4% again last night. So we've seen a fairly significant sell-off there. And yeah, as you said, those technical indicators, it's a key indicator, that 30-day moving average. So yeah, potentially some of the funds that follow the technicals could keep selling NVIDIA, and we have seen the NASDAQ market in general off quite a bit last night and over the last couple of days.
Now, meanwhile, gold has continued to rally to new highs. What do you see is actually driving that at the moment?
Well, I think probably a little bit of follow-on from that uncertainty that we were talking about, that investors tending to move towards gold. As I said, those bond yields, the long-term bond yields are indicating that the bond markets are concerned about long-term inflation. There's discussion about short-term interest rate cuts, but longer term, I think there's still an inflation hedge in place as far as gold's concerned, as well as that flight to safety. So we've seen, yes, as you said, the gold price reaching over that $3,500 per ounce US, and all-time highs. So I think that'll be a bit of a positive that we see on our market today, in that the gold stocks will do quite well. We also saw copper and oil futures up over 1.5% in each case. So I think we'll see a bit of strength in our resource market today.
Yeah, and of course, a lot of the stocks now trading ex-dividend post-reporting season as well.
Yeah, we saw that significantly yesterday. So Fortescue and Macquarie were two that had big ex-dividends in the last couple of days. So yeah, that plays into account as far as the share prices are concerned on a daily basis. From a cash flow point of view, that's a real positive. We saw in the reporting season, total of about $34 billion will come to shareholders by way of dividends over the next couple of weeks. So positive from a cash flow point of view. It just depends on how investors choose to reinvest that money, whether they hold a little bit more cash for potential volatility that comes forward, or whether they actually reinvest that back into the market.
And on the data docket, we do get that quarterly read on GDP today as well, David.
Yes, that's right. Yeah, the GDP number out at 11:30 today. Most analysts are anticipating between 0.3 and 0.5 of a percent growth for the quarter. So that would sort of indicate about 1.3 to 1.6% GDP growth for the year. Not extraordinary. We have seen a contraction in some of the public spending, and public spending has been fueling a lot of our growth over the last couple of years. So, yeah, it'll be interesting to see whether or not the GDP number comes in a little bit weaker, in which case people will be talking more about a potential RBA rate cut in September. It's probably likely, though, if the GDP number comes through at about that 0.5, that the rate cut will be deferred a little bit later in the year.
So, David, just getting back to where we began in terms of perhaps that seasonality typically that we see in September, does that prompt you to perhaps make some adjustments to the portfolio?
I think definitely that's the case. I think we see a lot of the institutions starting to look at their portfolios and look to rebalance. Those companies that have done well, and there are a number of companies that did exceptionally well through reporting season, there could well be a little bit of profit taking in those, and then reinvesting into companies that are greater value. We actually saw through August the small caps did really well. So small caps outperformed the large caps by about 3.2%. Growth for the small cap market was about 8% for August. So I think we're already starting to see a bit of that rotation, and as we've been talking about for quite some time, many of the large cap stocks, particularly the banks, are overvalued. So I think investors will take the opportunity as they pay their dividends and trading at fairly high prices to look at rebalancing, and potentially we might continue to see those small caps get a bit of a bit more favour.